Okay, so in this video, I'm going to talk about income statement projections and how that works out. So as a starting point, what you can do is something called the percentage of sales method, and that is to express accounts that vary with sales as a percentage of sales. And so basically, you would look at items like cost of goods sold, you find out what percentage of sales it was most recently, and use that percentage of sales to apply that to my projected sales figure to figure out what you think cost of goods sold is going to look like in a subsequent year. Um, so basically what you could then do is essentially use those percentages, use those projected sales, and then you get projections account by account by account by account. Now there are some limitations to that because some accounts might not necessarily change neatly with sales. And I'll talk about that a little bit more as I go. But as a starting point, basically what you would do is a percentage of sales. So to use cost of goods sold as an example, if we were going to project cost of goods sold, I'm going to take my cost of goods sold for the most recent period that I know. I'm going to take my sales for the most recent period, which I know, and I'm going to find that ratio or percentage of sales. So cost of goods sold over sales, I get a percentage of sales, and then I multiply it times my projected sales figure, and that would give me an estimate of my projected cost of goods sold. So notice I used estimate here, and I'm trying to kind of nudge you to say that mathematically I get a number here, but the reality is I don't know exactly like what's going to happen in the future. If I knew what was going to happen in the future, this would be so much simpler. But I don't know. So this is what I am projecting or expecting, and that it'd be somewhere around this number. Um, so from that standpoint, that would give me a projected cost of goods sold figure. Now, another way that I could do this, if you go back to a prior video when I talked about projecting sales and things like that, I could substitute for ST plus 1 with ST times 1 plus G. And if I do that, if I put ST times 1 plus G here in the place of ST plus 1, the ST here and the ST in the denominator there would cancel out. And what I'd wind up with is really what I'm kind of doing is just taking my cost of goods sold for the prior period and multiplying times 1 plus the growth rate that I was applying to sales. So in other words, if I am using a percentage of sales approach to a line item on the income statement, basically what I'm saying is I'm just going to take the growth that I'm expecting in sales and I'm going to apply it to every item that I'm doing this percentage of sales approach with. And so basically that would be, in effect, what I would be doing for every line item on the income statement. And that would give me my projected figures for each and every line. Now, let's kind of look at another little aspect of this. What if I was interested in not the total amount of cost of goods sold, but what I wanted to know was the change in cost of goods sold? Well, if I want the change in cost of goods sold, it turns out what I can do is I can take that percentage of sales, so this cost of goods sold relative to sales, I can take this percentage of sales, and instead of multiplying it times my projected sales figure, I can multiply it times my expected change in sales. So this triangle stands for delta or change in. So I can multiply times my change in sales. So if last year the sales were $1 million, I'm expecting the sales to be $1.1 million this next year. My change in sales is 100,000. I would use 100,000 for my change in sales, multiply times my percent of sales for cost of goods sold. That would give me my expected change in cost of goods sold. And ultimately, if you go back to that prior video that I did where I had some formulas for the change in sales, you'll realize you could substitute for the change in sales. And if you substitute for the change in sales, do a little bit of simplifying, what you find out is basically if I just want the change in cost of goods sold, not the total cost of goods sold, I just want how much cost of goods sold is going to change. Really, all I need to do is take my prior cost of goods sold figure and multiply that with my growth rate. Now, if you're thinking, well, this looks easier than this. Why are we talking about this instead of just doing it the easy way? I just multiply times the growth rate. Well, let's talk about that. The reason why I kind of let off with this, and actually would encourage you to do it that way to some extent, is because this forces you to think about the fact that you have expressed your cost of goods sold as a percentage of sales. And it means, and when you're doing this, you are assuming that that percentage remains true. So for instance, if cost of goods sold was 75% of sales last year, you are assuming that cost of goods sold remains 75% of sales next year. And it's kind of important to highlight that assumption that you're assuming that that proportion is the same. if I use this calculation down here, I mathematically get the same result. But I don't know about you, it's not really as clear to me just looking at this formula without thinking about it. It's not quite as clear that when I'm using this formula, I am inherently assuming that cost of goods sold is going to vary exactly in proportion to sales. And so it's not necessarily as clear to me that that is inherent in what we're doing here, but it is what's going on. So one advantage of doing it this way is that it forces you to think about the assumptions that you're making. Theoretically, you should get the same result either way. And if I go backwards, the prior slide, basically, theoretically, I should get the same projected cost of goods sold figure, whether I use this whole approach or whether I just take my cost of goods sold most recently times 1 plus the growth rate. But again, if I'm using this approach, it's not as intuitively obvious that I'm assuming that cost of goods sold has a relationship that's directly connected to sales and that the proportion is going to stay exactly the same. That's not as necessarily as obvious in this second formulation of the calculation. Either way, theoretically, you should get the same results if you're doing this right. But it's just, I think it's easier to lose track of what you're assuming. And that's why I tend to present this first method where I've got that percentage of sales first. And ultimately, if you're thinking about the income statement, basically what I would do is I would use that percentage of sales line by line by line. So I find my percentage of sales line by line by line by line on all the different things on the income statement. And then basically now, once I have my projected sales, I have the percentage of sales, I could just create a projection line by line by line. And that's basically what I would do line by line by line. So I just do the same approach that I'm doing back here, but instead of doing cost of goods sold, I might do, wages expense or, some other kind of operating expense and so forth, right? So basically that's what we do, just kind of line by line by line, all right? Now, that leads to some interesting kind of observations about doing this. If I do this on the income statement, I just do the same percentage of sales line by line by line by line on the income statement. What that actually means is that I'm going to assume that my profit margin is staying exactly constant. So if I vary everything with sales in exact proportion to sales, whatever profit margin I had in the most recent year is going to be the profit margin I'm going to show in my projected income statement. And there are some questions about that. So let's talk about that. What do industry trends indicate? If I look at industry trends and in industry trends, profit margins are declining, then that might be a little bit problematic to assume that I'm going to have the same level of profit next year as this year when everybody else in the industry, their profit is going down. So that's a little bit of a challenge with just doing a basic percentage of sales approach where I just express everything as a percentage of sales and just vary sales. Then we also have a few items on a typical income statement that if you start to think about it, might make you feel a little bit uneasy. So let's think about this for a moment. Cost of goods sold. Well, if I'm selling more products, so I increase sales, kind of makes sense. Cost of goods sold is probably going to go up. And it kind of makes sense that, it might actually go up in proportion to sales. Maybe that percentage holds true. Feel pretty decent about that assumption. But what about interest expenses? If I sell more product, that doesn't really mean that I wind up paying my lender more interest. I pay him interest based upon the loan terms, not based upon how much product I sell. So if I am going line by line on my income statement and I vary everything with sales, including interest, that's a little bit of a weird assumption that I'm assuming that interest is varying with sales. So that's kind of a challenge. Maybe I ought to not vary interest with sales. Maybe I ought to vary with what I think is going to go on with my debt levels. That might be a better approach. But that means I'd have to actually start customizing line by line, not just varying everything with sales, but actually doing more of a customized forecast line by line, perhaps. How about depreciation and amortization? Well, if I sell more product, that doesn't automatically mean I wind up with more depreciation and amortization. If I sell more product, probably wind up with more cost of goods sold. Probably means I wind up with more wages payable, probably more taxes payable. But depreciation is linked to my fixed assets. And I have a depreciation schedule for those. So if I don't buy a bunch more fixed assets, then if I sell more product, that doesn't really affect my depreciation at all. My depreciation is just going to depend on what my depreciation schedule is. So if I'm varying depreciation and amortization with sales, that's a little awkward. And also, if I think about something else that you might vaguely recall from accounting, I can have fixed costs and variable costs. So variable costs are the kind of costs that are going to vary with sales. That's why they're called variable costs. But certain fixed costs wouldn't necessarily change with sales, right? So for instance, the property taxes I pay for my facility, probably I don't wind up paying more in property taxes just because I sold more products. So there are certain fixed costs that I may have. Maybe the cost for insuring my building against fire damage or something like that. That's probably not really going to change all that much, if at all, with the amount of sales that my business is producing. So I could have certain fixed costs that aren't varying with sales. And so what that means then is that I actually really can make a good argument that there are some things on the income statement that would not be varying directly with sales. But there are potentially some challenges with that I'll come back to in a minute. So one of the things that is the side effect of having certain line items that don't vary with sales is it produces something called financial leverage and operating leverage. So here's what that means. Financial leverage is looking at that interest expense. And when I sell more product, my interest expense stays the same. And so unless I borrow more money. So sales go up, interest stays the same. And what that does is actually, if that line item stays the same, more of those sales dollars flow all the way down to my income line at the bottom, which basically means those extra sales are more profitable because some of these costs did not change. More of the sale wound up as income because I didn't pay more to my lender. So some of the costs just stayed the same, even if I sold a bunch more money, or sold a whole bunch more product and got a whole bunch more money, the cost didn't go anywhere. I just pocketed a whole bunch more. So that's basically financial leverage. If I've got interest expenses, or really actually preferred dividends are in this category too, but basically fixed financing costs where it's not linked to my sales. I pay my lender this amount, no more, no less. If I have a banner year, I don't pay them anymore. All the extra money goes to the shareholders, right? So that's financial leverage. Operating leverage is all about fixed operating costs. So if I've got fixed operating costs, fixed costs to insure the building, fixed costs, some kind of utility costs to just keep the lights on in the building. If I've got some kind of some sort of other fixed costs associated with running this business. If I have a fixed cost, sales go up, the cost is fixed. That's why it's called a fixed cost. And so if that's the case, more of those sales dollars flow down to net income. And that means sales could go up by, say, 10%. Net income might go up by 13, 14, 15%. And basically that's operating leverage. So with financial leverage and operating leverage, we've got certain line items on the income statement that actually probably don't change with sales. And as a result of them not changing with sales, when I boost the sales, I get a bigger bump in my net income on a proportionate basis than you'd think. So sales might go up by 10%, net income goes up by more than that because some of the costs just didn't change with the sales. So if that's the case, that means that, well, I'm making a pretty good argument for why some of the line items on the income statement, maybe I shouldn't be just varying directly with sales. There's some challenges with that. And that's where you start getting into, well, maybe I need to do like a custom line by line projection. Maybe that's better. So I could do a sort of a baseline where I just vary everything with sales and just I'm done with it, right? But then I've kind of ignored the leverage issue. I'm making some awkward assumptions. So maybe I do a customized line by line projection where I actually vary things uniquely and try to generate a sales forecast or an income statement as a result of that. But it's worth noting that's a lot more work and it's much more complicated. And it turns out, well, maybe just assuming things vary with sales isn't a terrible approximation after all. So for instance, if I increase my sales, and that means I need to say procure more assets, which I'll talk about in a subsequent video, that may mean I need to borrow more money. And if I borrow more money to buy the assets so that I can sell more product, well, the borrowed money would come with interest. So actually, maybe my interest cost would go up. Not because of the sales directly, but because of all the assets I bought with borrowed money, perhaps. And so then all of a sudden you kind of realize, well, okay, so interest doesn't change with sales, but if I sell a bunch more, it might trigger a whole chain reaction that of sales begets I need more machinery, which means I need to borrow money, which means I now have more loans, which means I now have more interest, which means, well, I wound up with more interest. So maybe varying the interest expense with sales wasn't so terrible of an idea. Maybe it kind of works out. So maybe the logic is sort of bad, but maybe the end result is actually a halfway decent approximation. That's a possibility, right? So it's possible that just varying things with sales might not be terrible. it might actually be kind of okay. But there are limitations that you should be aware of. And if you're dealing with unique circumstances, let's rewind a little bit. So a couple of years ago, as of when I'm making this video, at least, there was some pretty significant inflation, and that would have changed the cost of goods sold probably pretty significantly for various businesses. But that's not necessarily something you would have expected to continue long term, nor has it necessarily continued long term. And so as a result, that could, if you're in that kind of environment, you might project things like cost of goods sold are going to bump upward, but then they're going to go back to perhaps normal at some point. And so maybe I need to do a line by line projection because of unique economic circumstances. So I need to adjust certain forecasts. But varying everything with sales is probably not a bad place to start. But just kind of be aware there are some caveats and wrinkles when it comes to the income statement about maybe it makes sense to kind of think about what's happening with some of those particular items. Okay, now at the end of the day, when you get all the way down to net income can go one of two places. So either the net income can be paid out as a dividend to shareholders, or it can be retained. So, and if it's retained, it is more shareholders' equity, and it's going to affect the balance sheet. So if I'm going to project out my income statement, one of the things I'm going to get to eventually is I'm going to get down to net income, but we also kind of have to account for how we're going to split that out into either the dividends or the retained earnings. And that means we're making more assumptions. So you're going to make some kind of assumption about a retention ratio. What proportion of the net income the business is going to reinvest, and therefore whatever's left is going to be paid out as a dividend. And so that is something that's worth noting. If you're making a projected set of financial statements, you're going to get to that bottom line net income, but you're kind of you're not really done yet with that. You actually have to subdivide it into, how much is the company going to pay out in terms of in form of dividends, how much are they going to reinvest in the business, because that's going to affect the balance sheet. The balance sheet I'm going to talk about in another video. All right. Thank you so much for watching. Hopefully this video has been helpful. Hopefully it's made you think a little bit, and have a great day.